Welcome to Dennis Moneyball. I'm Roger Balser of Balser Wealth, where we cut through the financial jargon to help you make smarter financial decisions. No BS, just easing the money stress so you can enjoy the good stuff in life. All right, today we're just going to dive right in. I want to kick things off with a timeless quote from an economist. The economist's name is Josiah Stamp. He said, "It's easy to dodge our responsibilities, but we cannot dodge the consequences of dodging our responsibilities." Let that sink in just for a minute. Kind of hard to argue with it, isn't it? Today, we're getting into the cause and effect relationship between your approach to financial planning and the quality of what your retirement is. Like everything else in life, when it comes to financial planning, there are actions and there are consequences. I tell my kids that all the time. Make a decision, there's always going to be a consequence based upon the action. Now, making smart decisions, you'll be a wealthier person with more financial options. Make the wrong choices or neglect your responsibilities, you'll be less wealthy with fewer options. Things don't just magically work themselves out despite what you may hope. It's not magic, it's math. Now, why are we talking about this today? Because I see a lot of dentists who could be a lot further ahead. They had real financial planning done for them, or real financial advising, not just guys out there selling and not doing product salesmen. Now, everyone, they hit a moment in their life when they realize they've done a few things that probably are stupid, not really smart. We're just trying to minimize those things that happen, those moments. There's nothing worse than thinking you're on the right track, only to realize you did something that cost you hundreds of thousands of dollars sometimes. Now, statistics show a dentist, they're going to retire approximately 5 years later than the average person who, in many cases, is making hundreds of thousands of dollars less than they are. So why is this? Why do dentists retire on average 5 years later than the average Joe? Dentists have a lot more complexity in their financial situation than the average person does. They have more assets, more debt. They tend to spend more sometimes because they make more. It's hard to adequately address all those things that should be looked at every year because there's just way more to look at. So much of their planning gets pushed off or delayed. It takes a lot of time to do that. Let me give you somewhat of an analogy here for this. We're going back to Mother Nature. Let's say you got a really, really small farm. You can easily take care of it, can maintain that farm with pretty simple techniques, not a lot of resources, you know. It's not that simple though when you've got a big farm, a large farm. Think about irrigation. Goes from simply laying pipe to a massive irrigation system. It's run by satellite sometimes when you get bigger. Planting and harvesting for a big farm, you need multiple tractors, harvesters, dozens of vehicles to effectively manage your acreage. Now, even though you can produce more with that large acreage, the maintenance, the oversight, the management, everything else, it's just more complicated. That's just some simplicity. It's just more complicated. If you neglect the retirements of having a large farm, simply have less money. You have a big farm, makes about the same amount as what a small farm would do. Can't just have more stuff and neglect the maintenance and the complexity without having less yield. It's just the way math works. Now, imagine you have hundreds and hundreds and hundreds of acres. Some farmers, they even have thousands, tens of thousands of acres. It's easy to see how a good corner of that could just be unproductive. Nothing grows on it. For the person who owns 10,000 acres, it seems like it's not that big a deal. But when you look at the actual dollar amounts, it could be hundreds of thousands of dollars. Just went up in smoke because you missed 3 acres of a corner of a field that were neglected. It wasn't purposely, it was by accident. So why am I talking about farms and dentistry together? Well, when a dentist starts out, I think they've got a very small farm. The farm, that's the dentist's wealth. And the larger his wealth becomes, the more difficult it becomes to manage. Even though dentists have more assets, bigger businesses, and maybe even more potential, they don't always reap the added rewards because of the added complexity to do it the right way. Just gets bigger and bigger. It's one of the reasons why financial planning, financial advising isn't very straightforward to the dentistry for dentists. Another reason is there are so many definitions of what financial planning is. Financial planning is a relatively new industry. It means doing different things to different people. You think there'd be some common consensus about what you're going to get when you go to a financial advisor? Anyone out there who's basically tried to find someone and has done any research on financial advisors, you'll see there's a huge difference in their approach. And the advice that's delivered, it's really, really different. It's actually crazy, actually. Probably a lot of people out there who will tell you that financial planning is just putting money into a retirement account, setting up a 401k. That's good enough. Or just buy some good insurance. Let me get you in a whole life policy. That's your plan. Or just invest in real estate, pay down debt. These are all good things, except the whole life insurance policy. But the problem is the dentist isn't making a conscious decision to build wealth in what I call a balanced way. They're just check off the box approach. Nothing strategic in that. You need to have a plan, not just do things. 401k, check. Mutual funds, check. Insurance, check. Emergency fund, check. I did the check motion there if you couldn't see that. It's pretty common to hear dentists tell us, Raj, I got a 401k. I'm all good. We're good. Have a nice day. Battle's been won. Everything's good. Problem with that is, might be okay for one person, could be totally wrong for another person. So you have to adapt the plan to your personal situation, as I've said in different videos. So let's talk about 3 specific examples today. 3 different financial activities you should be doing, but maybe I haven't thought about so much. Let's say you and your advisor, you sit down, try to make an estimate of the amount of money you need to retire. Pretty basic thing most people do. One of the things in order to do that is you have to have an estimate of your personal spending. You have to have an idea on what you think you're going to need when you retire. I recently saw research from a national firm. Dentists estimate their spending somewhere around 32% lower than what they actually spend. Everyone always assumes they're spending less. That's just the way it is. Nobody wants to think they spend that much money. But this is a big problem. Your spending isn't something that you just all of a sudden change. Lifestyle spending habits, kind of like your diet. It's not something you just change because it's time. It's retirement time. We're going to cut back on our spending. It's years and years of habitual patterns that are hard to adjust. Those habits, they just increase over time. Easy way to avoid this is track what you actually spend. Pretty simple. Connect all your bank accounts, credit cards, see and put them into a system that's out there that tracks your data. That way we're not making guesses at how much you spend. We're actually tracking what is happening, what you're spending. The bigger your farm is, the more minor tweaks to start, they can make a huge difference. Miscalculation, a few $1,000s per month, result in a shortfall, $1 million when you retire, more than that sometimes. Another example, financial planning activities that dentists often neglect is doing regular practice estimates or appraisals. What's the actual value of your practice? It's important to protect the value of your practice and know, is it growing as an asset? Because let's be honest, huge part of your net worth, huge part of your after-tax capital you're going to need and that you're going to use at retirement. It's not something you can casually hope you don't need, because for most people, it's pretty important part of their retirement. It's also hugely important to know the value of your practice so you can know how to invest your money leading up to retirement. Something most people don't think about that. Think about this. If you know how much your practice is worth, you can make better investment decisions. Every investment you buy pretty much gives you an expected return. An expected return is a historical average for that type of investment over time. If you know how much your practice is worth, you're going to be able to predict how much money you'll need, how much you're going to need to receive when you sell it at the end of your career, which will affect the type of investments that you pick in advance that you are doing in other areas. If you know this, you'll be getting a lot of money in your practice. Let's just use an example. Say 62 when you sell it. You can extend the time frame for which you'll need to start withdrawing from your retirement accounts. It's going to actually change the type of investment you select by understanding how much money you're going to receive at retirement from the sale of your practice and how long is that going to last, depending upon how much you spend on an annual basis. If you're going to get a bunch of money in your bank account when you sell your business, you use that money for retirement income quite a few years sometimes, before you need to actually start withdrawing money from your other retirement accounts. And knowing how much longer your money is going to be sitting in different retirement accounts, well, it tells you and your advisor how much risk you can take and what type of investments you can buy. The more time you have before you have to start making withdrawals, the more riskier you can be with your investments and possibly the better returns you're going to get. Let me give you an example here. Let's think about this and see how this could play out. Saw it recently in a client's case. Dennis was given investment recommendations on his IRA by his advisor. Recommendation was overly ultra conservative because the client advisor had not taken into account the value of the practice when he was going to sell it. This client, they had a huge IRA account, 7 years away from his respected retirement date. The advisor, they were assuming that he'd be withdrawing money from the IRA in 7 years when he was done working, once he sold his practice. Took a look at the plan when we sat down the first time. I realized because of the sale of the practice, he would need this money for almost twice the amount of time, close to 14 years. So if we take the sale of his practice into account, had he and his advisor done that, his time for investing in the IRA would have been 14 years as opposed to 7 years. Dramatically changes the investment recommendations because it gives him more time. It ultimately creates more money and more wealth, in addition to the net worth he can use to spend in retirement, pass on to his kids, use for charities, or whatever he chooses to do or she chooses to do. It's really important to look at the value of your practice and assess its value regularly. Not to mention what would have happened if he had started with a more detailed approach much earlier in his career, had we talked much earlier in his career. Finally, let's hit our last example. We're often surprised at how little attention some dentists pay to the changes in their net worth. Those of you who don't know, your net worth is what you're worth if you add up all your stuff, all your cash, all your investments, all your real estate, your practice value, and then basically subtract your debts, what you owe on it. It's what you're worth. When you add it all up, what you own minus what you owe gives you your net worth. Usually when I ask somebody about this, the last time they checked it, believe it or not, was the last time they filled out, paperwork at a bank for a loan. On the applications, they ask you to add up everything. It's usually the only real time you're looking at it. Surprising how a dentist can go for a decade or more without seriously calculating their net worth. Plays a huge role in calculating your future retirement needs. Simple math, but you have to do it. It's just math. It's not magic. Your net worth needs to be large enough. To support your standard of living in order to retire comfortably. The net worth change you're experiencing from month to month or quarter to quarter, probably the most important variable to review on a regular basis. We track it for our clients on a quarterly basis. Every 3 months that you're working, we like to know how much you're worth. Over the last 3 months, think about it. What's happened? You spent down cash. You saved money. You spent money. You saved more money. You paid some taxes. Your investments might have gone up. They might have gone down. Real estate equity, well, that increased. The value of your buildings, your house, or your condos, well, obviously that's changed. Paid down possibly some practice debt that you had, some student loan debt, some personal debt. That might have changed. The value of your practice changed too, depending on any change in collections, up or down, that you've experienced. It's important to stop and pause. Ask yourself, how much more are you worth today than you were 3 months ago? Sometimes the asset's getting bigger, but people don't get wealthier. They don't make any progress. Looking at these changes in your net worth over shorter increments, the quarterly period of time, less than what most people do in 10 years, we can easily start to see, am I making progress towards retirement? It's amazing just looking at these numbers, seeing how they're actually going to affect the decisions we make for your retirement or you make for your retirement. Let's go back to where I talked about the farming analogy. Think about how important that is. The bigger your assets get, the bigger your farm gets, the more stuff you have. The harder it is to make sure you're actually getting wealthier and it's actually moving in the right direction. There's a lot of moving parts. Like I've been saying, All of that I just listed, all the changes that are going to happen, they happen each and every day, each and every month, each and every quarter. It's easy to figure out that all this business, I got to be producing something. I'm working my tail off. I'm productive. I'm stressed out though. It's way more complicated. I know firsthand experience. Being busy and being stressed does not always mean you're making more money though. You have to refine things. You have to adjust things. You have to make what are called course corrections in different areas. The first step toward accelerating your growth is really understanding the rate of progress you're making. What's the changes in your net worth? If you don't monitor or review the changes in your net worth, you're not going to know. You're not going to know how much to measure. You're not going to know how much you're truly succeeding, because the success of your decisions along the way, they got to be measured or reconciled, whether or not your net worth is increasing. If you're making all these decisions, but you're not getting wealthier, you need to rethink your strategy. It's also going to help you when you anticipate your retirement date, making the right decisions about when to transition the practice and how the lifestyle expenses need to be adjusted to protect your wealth. I like doing planning in this way. It's different. It's different from what most of our clients have experienced from others in our industry. Typically, you get some retirement projection off some software, tells us what the stock market's going to do for the next 40 and 50 years. And they say, here's what it might look like. The way we do it brings a real sense of progress, gives you a better idea on how to manage the project going forward. Let's say, look, last quarter, your net worth increased by 50,000. This is a pace you've kept over the past 3 years. So it's reasonable to assume we can maintain this pace, kind of like running a marathon. We know where we're at, which puts us with a lot more clarity than just printing out what we think the market's going to do, or doing a projection or a calculation based upon that. Nobody knows what the market's going to do in the next 10 years. It's surprising. I was doing a presentation a couple of weeks ago, had a bunch of people in the class, mostly students. They were surprised to hear me talk about the fact that we don't do forecasting. We don't do an investment forecasting to determine someone's retirement model. What I'm alluding to is that most financial planners and advisors, they do financial planning projections. They have all kinds of assumptions. What this does, it gives you a false sense of security. Gives you a false sense of security. If you track your net worth growth over the last 3 years on a quarterly basis, can't lie to yourself. You're either doing very well, falling behind, or you're just average. It's just a reconciliation with yourself to make sure you're actually being truthful with the progress you're making. Then, course correct, you'll be heading the right direction if you were heading the wrong direction. So there you have it. Financial planning for dentists. It's like tending to a farm. Bigger it gets, more complicated it becomes, harder it is to manage. Just like a well-maintained farm can yield a bountiful harvest, meticulous financial planning can lead to a prosperous retirement. Remember, it's not about magic. It's about math. Again, it's not about magic. It's about math. By tracking your spending, regularly appraising your practice, monitor your net worth, you can ensure you're on the right path towards financial security or making work optional at an earlier age. Remember, if you're not having these conversations with your advisor, it's time you start. Reach out to me at 440-610-3012. Shoot me an email, roger@balserwealth.com. Till next time, stay financially wise, because your financial future is worth way more than just 2 cents.